If you take a mere $100 a month and place it into a boring, low-cost index fund for 40 years at an average return of 10%, you end up with over $630,000. And out of that total, only $48,000 came from your pocket, because the remaining $580,000 was built entirely by the math doing what math does when nobody touches it. Yet most of you will never see that money, because you possess an inability to sit in a room alone and do absolutely nothing. You could stop listening right now, because that first sentence is technically the entire strategy, but you won't do it. And you won't do it because the human brain is wired for survival on the savannah, not for the counterintuitive arithmetic of compound interest. And Benjamin Graham, the father of value investing and the mentor to Warren Buffett, understood this tragedy better than anyone. Graham did not build his legacy by being smarter than the market, but by realizing that the market is a manic-depressive voting machine that exists to serve you, not to instruct you. And if he were starting from zero today with nothing but his labor and his intellect, he would not be looking for the next hot tech stock or trying to time the top of a crypto bubble, but rather he would be looking at the arithmetic of your life and realizing that your poverty is not a result of a lack of opportunity, but a lack of a margin of safety. You deserve honesty more than you deserve comfort, and the honest truth is that building capital from nothing is not a matter of brilliance. It is a matter of repressing your urge to be brilliant, because in the world of investing, brilliance is often the enemy of the good, and the desire to get rich quick is the precise mechanism by which you guarantee you will stay poor forever. To understand how Graham would build wealth today, we must first invert the problem, a technique beloved by his partner Charlie Munger, and ask ourselves, how do we guarantee we end up with nothing? We guarantee ruin by treating the stock market like a casino, by listening to the noise of the news cycle, and by paying exorbitant fees to managers who offer nothing but underperformance. So to win, we simply have to do the opposite. We must construct a lattice of mental models that protects us from our own stupidity. The first step Graham would take is to distinguish between investment and speculation, a distinction that has been lost in the modern era of gamified trading apps and social media hype. For an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return, while operations not meeting these requirements are speculative. If you are buying an asset because you hope someone else will pay more for it tomorrow, you are speculating. You are playing a game of musical chairs where the music eventually stops. And if you are starting from nothing, you cannot afford to speculate, because you have no margin for error. Graham would look at your zero balance and tell you that your first asset is not a stock, but your own capacity for labor, and the surplus capital you generate from that labor is the seed corn for your future empire. And eating your seed corn is the height of foolishness. The math of the $100 a month is simple, but the psychology of the first 10 years is a brutal test of character that most fail because the results are invisible. In the first year, you save $100 and earn perhaps $100 in interest, and it feels like a joke. It feels like an insult to your effort, and you look at your neighbor driving a leased luxury car, and you feel like a fool for denying yourself. But this is the trap. This is the filter that separates the wealthy from the consumers. The first 10 years are not about the money. They are about the habit. They are about proving to yourself that you can live below your means, because if you cannot manage a small amount of money, you will certainly not be able to manage a large amount. Graham would tell you that the market is a pendulum that swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. And the intelligent investor is a realist who sells to optimists and buys from pessimists. But if you are just building capital, you do not need to trade the swings. You just need to keep buying. You must automate the process because your willpower is a finite resource, and you will eventually have a bad day where you decide you deserve a treat more than you deserve freedom. The enemy of your wealth is not the market crash. The enemy is the fee structure of the financial industry, a parasitic layer of intermediaries that exists solely to transfer wealth from your pocket to theirs. Graham would look at the modern mutual fund industry with absolute disgust, seeing expense ratios of 1% or 2% as a moral depravity that destroys the miracle of compounding. You might think 1% is a small number, but let us look at the arithmetic. If the market returns 7% and you pay 1% in fees, you are not losing 1% of your money. You are losing nearly 15% of your upside, and over a lifetime, that 1% fee will consume nearly 40% of your total potential wealth. This is not a service fee. This is a confiscation of your future, and the financial industry spends billions of dollars on marketing to convince you that they have a secret sauce, that they can beat the market, but the data is irrefutable. Over long periods, almost no active manager beats the index after fees. Graham would bypass this entire rigmarole and buy the entire market through a low-cost index fund, effectively buying a slice of every productive business in the economy and guaranteeing that he gets the market return minus a microscopic fee. This is the ultimate defensive strategy. It is the application of the margin of safety to the decision-making process itself, admitting that you do not know which stock will win, so you buy them all. But the math is the easy part. The hard part is the psychology of the crash, the moment when the screen turns red and the news anchors are screaming that capitalism is ending. Graham lived through the Great Depression. He saw his portfolio decimated in the crash of 1929. He watched as friends jumped out of windows and fortunes evaporated into thin air, and he learned the hardest lesson of all, that the market can remain irrational longer than you can remain solvent. This is why he emphasized the concept of Mr. Market, an allegory where you imagine you are partners in a private business with a manic-depressive man named Mr. Market, and every day he comes to your office and offers to buy your share or sell you his. Some days he is euphoric and offers a high price. Other days he is depressed and offers a low price, and you are free to ignore him or take advantage of him. But you must never fall under his influence. Most people, when they see their portfolio drop by 30%, feel a physical pain, a fight-or-flight response that urges them to sell, to stop the bleeding, to make the pain go away. And this is the moment of maximum danger. This is the moment where you turn a temporary decline into a permanent loss. Graham would tell you that a market crash is a sale. It is the only store in the world where customers run out the door when the prices are slashed. If you are in the accumulation phase, if you are building capital from nothing, a market crash is the greatest gift you can receive, because every dollar you invest buys more shares, more ownership, more future cash flow. You should not be terrified of a crash. You should be terrified of a bull market where everything is expensive and your capital buys you very little. The media will try to scare you. They will tell you this time is different, but it is never different. Human nature is constant. Greed and fear are constant, and the arithmetic of value is constant. To build capital from nothing requires a stoic indifference to the opinions of others, a willingness to look foolish in the short term to be wise in the long term. It requires you to adopt a view of time that is almost geological, to understand that the first 20 years of compounding are just the warm-up act for the explosion that happens in the last 10 years. Look at the curve of that $100 a month investment. At year 20, you have a nice sum, but at year 30 it doubles, and at year 40 it vertical. A hockey stick of wealth that defies comprehension. The cruelty of compounding is that the majority of the growth happens at the very end, which means if you interrupt the process, if you panic and sell at year 10 or year 20, you do not just lose the interest, you lose the geometric explosion that was waiting for you at the finish line. You are killing the golden goose right before it starts laying. Graham would ask you to look at your life and identify where you are leaking capital, where you are paying for status instead of value. Are you buying a new car every 3 years to impress people you don't like? Are you paying high interest on credit card debt to fund a lifestyle you can't afford? This is not just bad math. It is a character flaw, a weakness of spirit that renders you a slave to the system. To build from nothing, you must become a producer rather than a consumer. You must view every dollar not as a ticket to immediate gratification, but as a soldier that you send out into the world to capture more dollars. This is the mindset of the capitalist, the owner, the person who understands that money is a tool for freedom, not a scorecard for social standing. The concept of margin of safety is usually applied to balance sheets, ensuring that a company has enough cash to survive a downturn. But Graham would apply it to your personal life. Do you have an emergency fund? Do you have skills that are in demand? Do you have the resilience to absorb a shock without collapsing? If you are living paycheck to paycheck, you have no margin of safety. You are driving a car with no brakes at 100 miles an hour, and it is only a matter of time before you crash. Building capital starts with creating that gap between income and expenses, widening it ruthlessly, and pouring the difference into assets that produce cash flow. You must invert the thinking of the average person who asks, "How much can I spend?" and instead ask, "How much can I keep?" You must look at the financial industry not as an advisor, but as a counterparty, a group of people who want to take your money through fees, spreads, and commissions. You must dodge their traps by refusing to play their game, by refusing to trade, by refusing to use leverage, by refusing to chase the hot dot. The boring path is the only path that works for the defensive investor. It is about waking up every day and doing nothing to your portfolio, about letting the businesses you own do the work, about letting the dividends reinvest themselves, layer upon layer, year upon year. It is about understanding that boredom is a filter, that if you need excitement from your investments, you are gambling, and the house always wins eventually. Graham would tell you that the true purpose of investing is not to become a billionaire, but to achieve a state where you are no longer dependent on the whims of an employer or the mercy of the state. It is about dignity. The $630,000 you end up with is not just money. It is 40 years of your life bought back. It is the freedom to say no, the freedom to pursue work that matters, the freedom to sit in a room and read and think. And yet, the temptation to deviate will be constant. You will hear stories of people making millions overnight in options or crypto, and you will feel a pang of envy, a feeling that you are missing out, that you are a sucker for taking the slow road. This is the social proof bias, the herd instinct that drives lemmings off the cliff. You must resist it with the ferocity of a survival instinct. You must realize that for every loud winner in the casino, there are 1,000 silent losers who went home broke. Graham's philosophy is built on survival, on the idea that if you simply avoid ruin, if you simply avoid doing stupid things, the natural drift of the economy will carry you to wealth. You do not need to be a genius. You just need to be not stupid for a very long time. This is harder than it sounds, because the world is designed to make you stupid, designed to trigger your dopamine receptors, designed to make you click and buy and trade. You are fighting a war against your own biology and against the most sophisticated marketing machines ever created. But you have a weapon they don't have. You have time, and you have the arithmetic of compounding. If you can harness these two forces, if you can set up the system and then walk away, if you can be humble enough to accept the market return and arrogant enough to ignore the market noise, you will win. You will build capital from nothing, because capital is just the crystallization of patience. The process is slow, it is grinding, and it is devoid of adrenaline, but it is the only way that is guaranteed by the laws of mathematics. The risk is not in the market, the risk is in you, in your inability to sit still. So the question is not, how does Benjamin Graham build capital? The question is, can you suppress your ego long enough to let him? You must invert your desire for action. You must look at the red numbers on the screen and feel nothing. You must look at the green numbers and feel nothing. You must become a machine that inputs capital and outputs freedom. The specific vehicle, the index fund, is just a tool, a vessel. The fuel is your discipline. The destination is autonomy, and the barrier is your own need to feel smart. If you can conquer that need, if you can accept that you are a tortoise in a world of hares, you will cross the finish line while they are sleeping by the side of the road, exhausted from their frantic sprinting. The $100 is just a symbol. It could be $50, it could be $500. The amount matters less than the consistency. The physics of the process are immutable. Start now, not tomorrow, not after you research the perfect stock, not after the market crashes. Now. The clock is ticking, and every day you wait is a day the exponential curve at the end gets cut off. You are not just investing money, you are investing time, and time is the one asset you can never earn back. Benjamin Graham would not pat you on the back and tell you it's going to be okay. He would look you in the eye and tell you that you are currently the architect of your own poverty, and that the blueprints for wealth are sitting right in front of you, covered in dust, because they are too boring for you to pick up. Pick them up. Automate the transfer, buy the index, ignore the news, focus on your skills, increase your income, keep your expenses low, and let the math do the work. It is ruthless, it is cold, and it is absolutely effective. The market does not care about your feelings. It does not care about your dreams. It only cares about your capital and how long you leave it there. Be the person who leaves it there. Be the person who understands that the greatest edge in the market is not information, but temperament. The world is full of brilliant people who are broke because they cannot control their emotions. Do not be one of them. Be the stoic, be the rock. Be the one who builds from nothing by understanding that nothing plus time plus discipline equals everything. This is the secret that isn't a secret. It is the wisdom of the ages, handed down from Franklin to Graham to Buffett to you. The only question remains, do you have the strength to be boring? Because if you do, you have the power to be rich. The choice is binary. You either play the game of the casino and eventually lose, or you play the game of the business owner and eventually win. Graham chose the latter. He built a fortune not by gambling, but by calculating. He stripped away the emotion and left only the logic. You have the same logic available to you. It is free. It is open source. It is waiting. The path is clear. The vehicle is ready. The math is verified. All that is missing is your consent to be patient. So give it. Commit to the process. Embrace the grind. And watch as the lattice of compounding constructs a fortress around your life. A fortress that no market crash, no recession, and no calamity can breach. That is how Benjamin Graham would build capital from nothing. He would build it slowly, methodically, and inevitably. And so can you. But you must start. You must invert your fear. You must embrace the boredom. And you must never, ever interrupt the compounding. That is the law. That is the way. And that is the truth.